Welcome to another Wealthstream webinar, where we bring you valuable insights from experts. Today we'll be talking to Jill Schlesinger. Jill is the Emmy and Gracie award-winning business analyst for CBS Radio and television nationwide, covering the economy, markets, and investing. And also just an all-around great friend and fun person. If you have any questions you'd like to add to the webinar, just please use the Q&A at the bottom to submit your question. We're going to do our best to cover them all. So, don't hesitate, and we'll take it from there. So welcome, Jill.
Thanks, Michael. Great to be with you.
Yeah, always is. Thank you. We're really happy you're here today. I thought a good way to kick it off would be for you to just give a short story, a little bit about how you got where you are, because you've had such an interesting career with different, roles in different industries, all financial related, but very different roles in finance. And I think the audience would really appreciate knowing that path that you've taken.
Sure. There's nothing I like more than talking about myself. So that's why I go to therapy. So this is better than that. I'm taking the glasses off for this. Oh, let me fix my hair. I have a very untraditional path to where I am. I am not a trained journalist. I essentially got my start in the world of Wall Street because my dad was what's called a specialist on the American Stock Exchange. It was a guy who traded stock options and stocks. And so many of my summers were spent working for him. His best friend worked across the street on the New York Stock Exchange. I worked for him as a clerk. So my first job out of college, I was a very unglamorous job, which was trading on an actual trading floor, the Commodities Exchange of New York. I started in 1987. There were 800 men. There were 8 women. It was like a rugby scrum with money involved. And so I did that for a few years. And, I think around the 4th-ish year, I was just not really feeling it. And I didn't think this was the path for me. I ended up moving back to Providence, Rhode Island, where I had attended college. That's a different podcast, which is I chased after a boy up there, but that's not for this one. And when I got there, I didn't really know what to do. I banged around a little bit with doing different things, nothing that interesting. And I landed in a place where there was a young guy who had started a financial planning and investment management firm. And he was connected to me through a mutual friend. And I went and talked to him and he says, "You should do this." And I said, "What do you mean? What's this?" He says, "Come spend the day with me." And I actually really learned a lot. I had knew nothing about working in a client business. I really was fascinated by somebody being able to use the little bit of their math smarts and their emotional smarts to help their clients get where they want to go. I joined that firm and became a financial planner and became a certified financial planner. I did it for 14 years. And, after my first year, I became a partner of this firm and an owner. We grew the firm, we sold the firm. And in fact, that is how I met Michael Goodman, everybody, origin story of Michael and Jill becoming friends. We had sold our company and the firm that bought us said, "We'd love for you to talk to this guy in New York. We want you to convince him to sell his firm." And so that's how I met Michael Goodman. And I did not convince him to sell his firm, but we became very good friends. And so there that is. One of the ways that we grew our firm over those years was that we hosted a radio show, a call-in radio show, which led to doing some local television and also doing some network television because I had then met my now wife. See, that's part of the longer story. It's a different podcast. And I ended up wanting to do more work in New York, where I'm from. And I was on CNN and Fox Business and Fox News. And someone from CBS called me up and asked me to appear in some of their pieces during the financial crisis, the very early days of the financial crisis, early 2009. I had gotten out of my company. CBS calls me up. They said, "We'd love for you to work with us full time." I said, "Absolutely no way. I'll come in and talk to you." 3 weeks later, I signed a contract, and that was 16 years ago. Here I am. That's it.
Yeah, I think that's an amazing story. And I bet a lot of people don't know that story about you. And I think that is part of the reason why you're so good at what you do, because you have the angle, the markets and how they work from your early days trading.
Mm.
You're a CFP, a certified financial planner, and you've worked with clients for a very long time, over a decade, where you talk to them about not only investing, but as we know, all the things that go on behind the investing and the why, and understanding all the worries and the concerns and the dreams and the goals that people have. And I think that is, you combine those that all together is what makes you such an effective journalist, but more importantly, someone who can speak well to the people, if you will. You
Yeah,
have that reputation.
you know, it's funny. It's like I don't really consider myself a journalist. I know I'm on TV and I'm on the radio and I do podcasting because I am not someone who's studied journalism. And a lot of what I had to learn on the job is very different than anything I could have ever imagined. But what I think being a financial planner really does is puts you in touch with how people are feeling about their money. And I think that part of being a financial planner and what I bring from that experience forward in this world where I'm speaking to, you know, depending on the day, millions of people, but sometimes just hundreds of thousands. You know, what it does is it's a nice reminder for me that it doesn't matter about all the jargon. I know a lot of people here might watch CNBC just for fun, or maybe that you listen to Bloomberg or watch Bloomberg. I find that to be incredibly boring. And there's a couple of friends I have who work there. They say, "Why do you keep saying we're so boring?" And I said, because you really think what you're talking about matters. And what I think really matters is what is it that somebody is feeling and thinking about the news and how they take that into their own personal financial lives. That to me is the only thing that matters because everything else is just noise.
Yeah, I obviously completely agree. We're going to talk about some technical things today, but what might be ironic is that every time we talk about something, the end advice piece or how it really relates to people is going to be what's important to them, how they feel about it, how they sleep at night, and what gets them to where they need to go, not necessarily some of these technical elements that people tend to overfocus on. So, with that in mind, as we transition into some of the more technical elements, I would like to point out something I saw today actually in the news, and that talked about how for the first time ever now, more people are getting their news from social media than they are from TV. This is a very recent change. Obviously, there's all kinds of social media, but that in itself is an opportunity and a challenge. And I'm curious to know what you think about that, Jill.
You know, I understand this. Of course, I'm sort of wrapped around these numbers like crazy because at CBS News, we are, you know, basically an institution that has been facing that reality for some time. So maybe more than most, I understand that that is happening. You know, I always joke if someone says to me, "What do you do?" I really kind of size them up age-wise to see whether it's worth it to tell them what I do or not. You know, for sometimes I'll say, "Okay, they're under 40." I'll just say I host a couple podcasts and a radio show. Radio, that's still on, yes. So listen, I think there's really instructive about this is that we are in our own echo chambers, and we're also in our own echo chambers about all news. But what we found because of this is that as a network that does, you know, reach millions of people, it was very important for us to repeat certain things that we may have taken for granted in a bygone era. So when we were talking about tariffs, we know that there was a slice of people who may have just turned the channel on or literally watched a football game or a basketball game or a sporting event the night before on our network or watched their local news, woke up in the morning and CBS Mornings was on the air. And when I was talking about tariffs, every single time I reminded people who pays for tariffs. And I would say it every time because I think on social media and certain parts of social media, there was this weird view that like, oh no, you know, the country that exports is going to pay the tariffs. No, not true. So I think what it does is it is important to recognize that that's why so many people who are absorbing news they think is news, a lot of it is opinion, a lot of it is nonsense. If your kids are watching finfluencers on TikTok, they are getting messages. Some of them are good. A lot of them are crap. So we just need to understand that and decide whether or not we're going to enter that world. Now, you know, listen, every day that we go, when we have a broadcast for CBS, every day, every single segment is chopped up. And some of those segments are put on Instagram and then put on TikTok and this, that, and the other thing. But at the end of the day, I don't know if that's really breaking through. You know, really, the most important name brand right now is probably Joe Rogan. And, you know, unless he invites me on a show, which I'm happy to do. But I think that you have to at least recognize that and at least adjust your messaging for that. I think for a lot of people, if you have kids, if you're trying to help them, get to a different place, if they do watch a TikTok influencer or they're following someone on Instagram, it is worthwhile saying, who is that person? Or talk to them about it to see whether they're registered. Most of them are selling crap. And but some of them aren't, and some of them are good, and some of them are really interesting. And there's a young woman who's an economist. Her name is Kyla Scanlon. She has a huge social media following, and she is whip smart, and she happens to be the human being who came up with the term vibe session, that during the big inflationary peak, she came up with this idea that the vibes of the younger people were really looking like recession vibes, even though we were not technically in a recession. And I think so there are some people out there that are spot on and are great to follow.
Yeah, I completely agree. I'll probably say that a lot today, but I completely agree. I think what is interesting is there's this sort of dichotomy in how I feel about clients and the news. There's a part of me, of course, that wants them to be very tuned into the news. Of course, we prefer it to be an objective news source, and we enjoy that because the most educated clients are usually the best, and happiest relationships. On the other hand, a lot of the news around investing, around the economy, really doesn't mean that much to most of our clients because we're not investing in a way that we're trying to capitalize what happens today. We're trying to make sure we capitalize what's going to happen for their lifetime of investing. And the worst thing that you could do, as you know better than I, sometimes is to make these short-term changes based on short-term events that are happening in the news that really have no impact on the arc of your investments.
I mean, I can't emphasize enough how much the news flow can really be damaging to individuals, which is bad for my business. I get that, but I'll give you an example of that. When we were having the first conversations about tariffs. So we'll go back to April 2nd. Remember April? Oh my God. Okay. So April 2nd, we have this Rose Garden announcement and the stock market rolls over. And, when I went on the air, one of the anchors said to me, you're always kind of almost weirdly zen when we have these huge market sell-offs. And I think that part of that comes from my training as a trader, because, the first thing I think about when there is big volatility, especially on the downside, is what can I do to acknowledge that it's scary and also tell people not to do anything? And I learned this lesson in the financial crisis because one time I went, like one of my early hits on CBS, I looked at the camera, I said, look, just don't panic. And my mother called me up after and she's like, don't tell me not to panic. She literally said that, don't tell me not to panic. Thank you, Susan. And
Yeah.
the thing that was very important to me to remember is that people have their feelings. You're not going to make those feelings go away. So what I started to do every time the market was rolling over is I would say, I totally get it. It's scary.
Yeah.
But almost like my tone of saying, but listen, let's remind ourselves. Most of us are long-term investors. We're not day traders. Most of us are this. We're trying to do this. You're sticking to a long-term game plan. All the things that you tell your clients when there is the exact same events. And, maybe we have trained people enough because, by the way, in a lot of these sell-offs, it's not retail investors like the normal people, the Wealthstream clients, the people who are managing their own money at Schwab and Vanguard. They're not selling. It was actually the professionals who were doing a lot of selling. But what I think is really an important part of the news cycle is that when you take so much in, it's almost like doom scrolling. It's not doing anything good for you. And
Yeah.
so I'll quote somebody that you and I both love, and that is David Booth, who is one of the founders of Dimensional Fund Advisors. And he's also the namesake of the Booth School of Business at University of Chicago. And when I interviewed him recently, it just really struck me that he said, being an investor means just being a human being. Life is uncertain. Investing is uncertain. The key is to tune out the noise so that you are not distracted from what your ultimate goal is. There are going to be periods that are painful. You're not going to probably avoid them. Being a long-term investor is pretty much signing up for the fact you're going to have a 20% fall in the stock market every 5 to 10 years. And sometimes it's going to be worse. And sometimes it's going to take longer to recover. But that is what it is to be a long-term investor. You are kind of buying the ticket of admission and you're on that roller coaster. I know we'd like to be on the merry-go-round, but the merry-go-round means that you're in just a bank CD, fixed income only portfolio. And if you're going to be an investor in things that can go up and down, then you've got to prepare yourself that you'll go through those times. And it is scary on the down. It is scary, but my job and your job as a professional, Michael, is to talk to people in a way that acknowledges that it's scary and also remind them why they can look through this period and understand that their long-term goals are still ahead of them.
Yes, most assuredly. So let's jump onto some of these more specific issues and
Okay.
chat about them for a little while and see how that relates back to what you've been talking about. But I think the hot button, well, there's probably about five hot buttons going on right now. You talked about tariffs a little bit, so let's find a different one for a moment, and perhaps inflation, which obviously dovetails right into interest rates. But what are you seeing, hearing, talking to people around their fears around inflation and what's going on in the markets with respect to that?
We're human beings. I don't know. Breaking news, put that on the bottom. Human beings. So, what happens for us is whatever just occurred in our recent memory is what we kind of latch onto and we bring it forward to what we think is happening today. So, obviously, the fact that inflation surged amid the COVID reopening from 2021, peaking at in June of 2022, that was very scary, especially to people who had never experienced any inflation. I mean, you and I, Michael, are sort of at the age where we kind of sort of remember it because like our
Hmm.
parents had to wait in line for gas, but
Yes.
we didn't live it. And so this is a very different feeling for a lot of people. And it was scary. We went from 0% inflation to 9%, 2% inflation to 9% inflation fast. Okay. So now dopes like me are on the air and we're saying, hey, these tariffs could cause some prices to go up. We might see a reacceleration of inflation. Now, bingo, remember that breaking news? You're a human being. You're a human being. You hear the word inflation. And what do? You immediately go back to the summer of 2022 and say, oh, no, I can't do that again. That's scary. And that's not what is expected. So when you talk to economists like I do all the time, there is a sense that these tariffs, and even if they're just stuck at these levels, like we don't have to have 145% tariffs, like tariff levels right now, if we were just assume these persist throughout the end of the year, 10% blanket tariffs on everybody, 30% on China, steel, aluminum, cars. If you just assume that, that is the highest tariff rate in decades. And that would likely mean that the cost of certain things will rise. The inflation rate right now is at about, well, let's call it 2.5%. Okay,
Hmm.
about. We're not expecting the consumer price index, the one measure of inflation. We're not expecting 9%. When we say rise, we're saying 2.5 to maybe 3.5 by the end of the year. Okay, that would stink, but you don't have to brace for landing like you're like dropping 9,000 feet from the sky. What you have to think about is it's like we're going to go through a period where the price of certain things is going, those prices could rise. We don't know whether it's going to feed through the entire economy, but what is likeliest to happen is that inflation rate will start to creep up over the next few months, over the next 6 months. And that's going to be a moment where individuals, you and I, are going to make different decisions about how we spend our money. And the different choices we make are probably going to help push down the inflation rate after that. So we're likely to go through this period where we're going to see a little more inflation.
Yeah.
It's going to be tough. Like if you're going to do, I'll tell you what I notice it like most specifically. I spoke to a friend of mine who's a designer, like a home designer, high end
Hmm.
stuff, right? And I
Hmm.
said, tell me about pricing projects right now. She goes, well, you can tell all of your listeners that if they're doing a home improvement project or a real big renovation, that whatever that architect or that designer or that builder gave them as a price, they have no idea what prices are really going to be. And they should tack on 25% to whatever they think the cost of that job's going to be.
Yeah,
And if that's happening, you might say to yourself, you know what? I'm not going to do that job.
that's right.
I'm going to delay that job. So again, there's a choice. I think that what is important about the inflation story is not so much what happens now, it's where are we in 2 or 3 years?
Yeah.
I
Yeah.
don't know the answer to that. I don't know if you have an opinion about that, Michael. I mean, my sense is that, and again, this is one girl's opinion. We see a little bit of a move up, but a lot of the things that are happening in the economy are kind of deflationary to me. You know, if you think about it, we'll talk about AI, but if we talk about if we just look at the labor market and we look at where wages are and we look at kind of the demographics and what's happening, I still feel like the inflation rate is going to settle down. I don't know if it's going to settle at 2. And that, by the way, that's an arbitrary number. The Fed made that up. There's no like actual magic golden ticket from Willy Wonka at 2% inflation. It's made up. And if it settles at 2.5 and the economy can grow at that level, then we'll be happy. We'll be fine.
Yeah. I think the hardest thing with inflation is that there's all these other things that are not in the windshield right now that you can't see that are going to come in and impact inflation. Of course, there's some really brilliant people that can go out right now and say, based on everything we know today, this is the trajectory. But new information is coming into the market all the time. And with inflation in particular, some of those things are typically surprises. So it's a very hard thing to predict. I think also what's interesting about inflation is everybody thinks that prices are going to come down. Prices went up. When we say inflation is 2.5%, as you said, that's the new increase. If prices have increased, now I'm not saying all prices will stay high, but generally speaking, when we throw that data out there, it's about the additional increase. It's not the prices coming down. So I think
Right.
that's number one.
Yeah.
And number two is with inflation is we talk about a lot of these interesting concepts. We'll touch on interest rates next, but inflation and interest rates to some degree, but surely inflation is one of the few things we can talk about in the market where it impacts people in their pocket today. And it's scary because if you're living on a budget or a mindset of I'm going to spend this much money, and now all of a sudden a couple of expense items, not discretionaries like the home improvement you mentioned, but the day-to-day things, whether it's filling up your gas tank or buying eggs or bread or whatever it is, that's a scarier thing. And I think that makes people make bad decisions about their long-term investments because they're being impacted today.
You know what's interesting about that? I've one of my colleagues is going down to the Fed meeting right now. She's going down there for tomorrow, and she said, "What's the question you want to ask Jerome Powell?" Jerry? No, I'm just kidding. He's Jay.
JP, I think it is.
I think they call him Jay. So I am very interested in this idea that the Fed has 2 jobs called the dual mandate. On one hand, they are tasked with managing monetary policy, just like how they manage the bonds that they own, how they manage short-term interest rates. That sound like a superstar. You just now you know what monetary policy is. If you slept through Econ 101, okay. So you've got one job, which is try to make sure the economy grows enough to create jobs for basically anyone who wants it. Okay. So if you look at like population growth and immigration, let's put that aside for 1 second. But if you look at population growth, we need to create like about 120,000 jobs a month just to keep up with like new people coming into the labor market. And so the economy, if it's growing, will do a lot more than that. And if it's shrinking, may do far less and actually cut jobs. Okay. So jobs, one side of the Fed mandate. The other side is prices. Price stability is what they call it. You and I think of it as inflation, but very interestingly, talk about me fangirling out once when Ben Bernanke was in the green room at CBS right after he stepped down. I pulled him aside outside. I pulled him out of the green room and I said to him, "What's up with getting the inflation rate higher?" And he said, "We'll never get inflation up. It's just a problem here in the US. We have a really stagnant inflation rate. Everything we've done to kind of juice the economy has kept inflation low, below 2%. That was the biggest problem that he identified at that moment. Now
ironic.
Isn't that amazing? And
Yeah.
so what I think is important about the Fed is breaking news. They too are human beings. And they are also influenced by the recent past. So the Fed is trying to have this delicate balance between making sure that they don't keep interest rates so high that it chokes off economic growth, but that they don't drop them so quickly so that there would be additional inflation. And when interest rates were at 0%, it was because there was this real fear. And what happened in 2008 and 2009, which came to fruition, was that we were seeing deflation. Prices did go down. And that's a good clue to yourself. If you're thinking, I wish prices would go down, you kind of don't, because that probably means we're in a recession. So we are where we are. We now have a certain amount of inflation. And now the Fed is tasked. Which side is more important? So the question that I think would be interesting to Jerome Powell is something like this. And I never go down to DC for these meetings, so I let my colleagues go off and do that. Chair Powell, you have a dual mandate. When you make a mistake on inflation or prices, it affects 100% of the population. If you make a mistake on growth and you're wrong and we go into a recession, maybe we'll get a 10% unemployment rate. Maybe the stock market will go down, but that 10% are losing their jobs or having a problem finding a job seems a lot better than 100% of the folks who are impacted by inflation. Chair Powell, which is more important? And I don't know if they consciously have that conversation. You know, you'd have to look at Fed minutes. But what I think is true is that, again, human beings are influenced by what has just happened. What just happened to Jerome Powell and this Fed? They really were late on raising interest rates in reaction to inflation. They do not want to make that mistake again. And so I think that inflation is casting a longer shadow. That's the problem with inflation. That's why we don't like to see it rise, because it casts a long shadow with consumers, with businesses, and with the Fed itself. So I think that inflation kind of does what it's going to do. The Fed can influence it to some extent based on policy. But I think that, as you say, one of the problems as an individual is, how do I factor that into my planning?
That's right.
What do I do? So Michael, when we first entered the planning business, so when I did, it was in the 90s. What inflation rate do you use for long-term planning? I remember this to a T. So what inflation rate did you use?
I used to use 3.1.
Okay. Because I'm much wimpier than you, always used 3.5.
Wow. Yeah.
Because
now we're even lower, by the way. Yeah.
Okay, so I used to use 3.5 because I said, what's the worst thing that happens? You end up with more money.
Yeah.
It's not so bad.
No.
So to factor this in, and one of the one of the most beautiful aspects of working with a financial planner, a certified financial planner, like one at Wealthstream, is to have somebody who can be your springboard, can say, look, we ran your planning at 3% or 2.5%. We did that. So we factored this in, and it's scary this minute, but you don't have to feel like this. Look, inflation is a real psychological issue. You know, the last New York Fed report showed that 1 year inflation expectations were 3.2%. So in a year from now, people think we're going to have 3.2% inflation. 3 years from now, it's going to be 2.8. 5 years from now, it's going to be 2.3. I wouldn't be shocked if that were the case.
Yeah. All things being equal, I think that's a reasonable trajectory, barring what I said earlier about all the stuff we don't even know that's going to occur over those years.
Right. I mean, by the way, if Iran shuts down the Strait of Hormuz, inflation's going up in a big way.
Yeah, especially because of energy.
Yeah.
The back to the planning, a couple of points I just want to touch on from what you said is, what's the cool thing about the planning is we don't lock in a plan at a particular inflation rate. We can show clients in different time periods or different time periods of inflation stress how this will long-term impact your plan, and see if you have that sensitivity to inflation in your plan or not. So we definitely consider that.
But if you feel like you don't want to pay for your kids' grandkids' summer camp, you can just say, inflation. Sorry, kids.
Yeah,
you're on your own.
It's a great excuse, no doubt. Going back to the Fed and probably more even into the interest rate side, and also with bonds. So I kind of want to talk a little bit about that and what the reaction's been around where interest rates should be, but also about U.S. government bonds and this perception of reality of needing to cover the deficit, and the new tax law that's coming out projects out, I think, another 2 trillion or so in debt, and the government might need to issue more, and the government has to pay interest on these bonds at higher rates, and whether we're getting the support internationally ongoing of buying U.S. government bonds? Are those still sort of the standard?
Mm.
So if you could talk a little bit about all those things in a nice little simple, concise way, Jill, that'd be great.
I would love to because at CBS, I've been told not to mention the word bond on the air. I'm just kidding. That is true, though. In 2008, they said, please don't mention the word bond. Nobody knows what that is. So
Wow.
that was, yeah. And I was like, I kind of have to. Sorry. If I'm going to talk about, credit default swaps, we're going
Yeah,
to get
yeah.
there. Okay. Everyone take a deep breath. Hey, by the way, Michael, you didn't tell people they could ask questions in the chat. Are you not letting
Oh,
them?
yeah. Please do put in any questions. We have some we're going to get to in a little bit, but as you can see, time flies and we're having a great time.
Yeah, we're
So
staying here
put
for
those,
3 more hours and we're going to have cocktails. My
yeah.
only thing is I got to go see, I'm going to theater tonight. That's it.
All
Okay.
right.
That's my limitation. Okay. So everybody here who is watching this webinar knows that a bond is basically an IOU, right? You buy a bond, you're lending some entity money. That's it. I'm making a loan. Sometimes I make a loan to the United States government. If I make a loan to the United States government for 10 years right now, I am going to get, what's the market look like? 4.5, 4.6, 4.6%. Okay. That's it. That's your bond. If you hold the bond until it matures, whatever the interest rate was when you bought that bond, the issued interest rate, if you bought it at the auction, that's what you're going to get over 10 years. Hold it. The price can go up. The price can go down. Why would the price go up? Isn't it just that bond prices can go up and down? Unfortunately, we found that out in 2022. It was
Yeah.
a very unhappy moment. Me being, I love bonds. I love bonds because I just told you I'm a wimp and I'm also like a little bit of a math head. So there are only a few variables when it comes to bonds, especially government bonds, which really are predicated on the wherewithal of the borrowing entity to repay your loan. So if you're lending money to the US government, they're going to probably repay your loan. Probably. Okay. Hold it for
Pretty
10,
good bet.
right. Hold it for 10 years, you get your money back. Price goes up and down based on what other bonds are paying throughout that period, right? So if I have a bond and it's paying me 4.5% today, I just bought it. And 5 years from now, all of a sudden interest rates go down. We're in a horrible recession. And now if you want to go out and buy a new bond in the marketplace and you lend money to the government's you're only going to get 3%. So what's the value of my bond that's guaranteeing me 4.5%? It's a higher value. That's why we say that bond prices are inversely related to what's going on with interest rates. Interest rates go up, then someone can buy a new bond, get a higher interest rate. So if you want to sell your bond before its term is up, you got to lower the price. Okay, bonds 101, done. Now, when we look at interest rates for the next 10 years, you would say to yourself, oh my God, the debt, the deficit. Can we do quick definitions? Deficit is the difference between the money that the government takes in and the amount of money that is spent. When we spend more than we take in, we run a deficit on an annual basis.
Yep.
And those gaps, the extra dollars we spend, they pile up over time. That's the national debt. National debt right now is $36 trillion. Like, not all of it is held by individuals or private, but whatever. We just say, like, let's just put in your head $30 trillion of debt. That's what we have. Wow, that sounds like a lot. It's a lot. The biggest contributors to the debt for the last 25 years, the war on terrorism after 9/11, that was a biggie. The financial crisis,
Yep.
that was a biggie. The Trump tax cuts in 2017 that went into effect in 2018, that was a biggie. And the pandemic.
Yeah, for sure.
Those are the four biggest contributors to the national debt deficit problem over the start of the century. So when does it matter that we're carrying these big deficits? I would say, now it's almost like 35 years that I've been doing this. I would say that every day that I have ever been in this business, I can find someone who says, we are going to pay a terrible price for all this debt as a country. Those are people who are called deficit hawks. And the reason that they think we're going to pay a terrible price is that they're going to, investors are going to say, well, it's so much debt and you're not raising taxes enough. And so therefore, we're going to demand a higher interest rate, or we're not going to actually buy your bonds. We're going to buy other stuff. So there is some minor evidence that could be happening right now, right? But I would suggest there are some other things that are happening that are causing some gyrations in the bond market, not just debt and deficit. And one is that we have allies in Canada and in Europe who are now gearing up to prepare for a period where the country they thought was a great ally, the United States, may not be. And so they are trying to diversify some of their investments. So they are letting some of their bonds come to maturity, and they're not buying new bonds. Maybe they're buying their own bonds. Maybe they're buying German bonds. Maybe they're buying gold. Gold just reached an all-time high. Maybe they're buying a little crypto for the heck of it, but they're diversifying a little bit, not a lot of it, a little bit. And so I don't really think there's going to be I'm not sure that we're going to have what we like to call a Liz Truss moment. Oh, definitely bring this up with any British friends of yours. Liz Truss was the Prime Minister of the United Kingdom for about 5 minutes, and she created a budget that was spending like crazy, that would have exploded the debt, and the British bond market went ballistic. Like, it was scary, and people were very freaked out. And she then lost her job. Like, it was done, like within minutes. And there was if you want to Google something fun, you can see, just Google Liz Truss lettuce head, and you'll see the question was, would the head of lettuce last longer than Liz Truss? And I believe the head of lettuce won. So in our country, I don't think we're in that same situation. We are the world's reserve currency. I think that there is going to be, I think the real situation that we're in really looking at has less to do with debt and deficit, and more to do with how are we going to meet the obligations that we have made, or the promises that we've made. So do I think that bond rates, like, it's not that different. Like, we've had a lot of crap flying for the last 6 months. I don't know, where did the bond market close on December 31st? Not that far off from where we are. So there's been a lot of gyrations. There's been debt deficit worries. I'm kind of the person who, like, even if it were a worry, what am I going to do? Like, I mean, you could have.
Well, does it really matter?
I mean,
Does it
like,
matter
really? I mean,
does it matter to your portfolio?
Or and you don't necessarily. A lot of people think, oh, I own bonds. So yeah, you own bonds. You don't own only government bonds, and sometimes you own and when you're worried about changes, maybe you own shorter duration bonds. Right? And so I know you do that work all the time. But I think that the natural inclination is to compare the United States to your family's budgeting and balance sheet, and it's not. It's different. We can print money. Guess what? Like, it's a great feature and a bug. But we don't have to worry about that. So when people say, "Should I worry about the debt and the deficit?" I'm like, I don't know. Do you have anything else that you want to worry about? Like, I could think about a lot of other things to worry about.
Well,
and where do we think bond yields and prices are going? I don't have to worry about that. That's not my job. My job is to be a diversified investor over the long term. But I am going to tell you that I do think that even though we're in the middle of watching this terribly named bill go through now the Senate, because I want everyone to think about what it's called. It's called ABBBA, a big beautiful bill, or something like that. ABB. All right. This was a big miss. This is why no one in Congress has a sense of humor. If they really wanted to do it, they would have said it's a big beautiful bill, or a big beautiful act. That would be it. ABBA. And then it would be ABBA. And then we could have a running theme when you go on the website of Congress, that there would be Dancing Queen playing. It would make us happier about the fact that there is a problem with this bill. This bill is problematic because this bill doesn't pay for a lot of the things that are going to benefit many of us. Okay. We're going to have lower tax rates. Great. But what's also going to happen is we have, a social safety net system, specifically Social Security, that has a big problem right now, that has now going to encounter a period of time where we will only be able to pay out about 80% of the promised benefits right now. That's what we're looking at in, I think it's 5 or 6 years. Okay. If we don't have enough money, you don't even need Congress to get together. You know what automatically happens? By statute, it gets cut. And so that means we need a lot of people getting their voices together to say, hey, we need you to fix Social Security. We were counting on 100% of my promised benefits. So that's why I think when you talk about the debt and you talk about the deficit and you talk about this bill and you talk about everything, I boil it down to real people. Real people who thought they were going to count on some stream of income from Social Security can just reduce whatever they thought they were going to count on by 20% right now, unless somebody in Congress, hopefully people from both sides of the aisle, are so racked with inbound calls and concerns and protests that they will do something about it.
Yeah.
That's my biggest fear.
Yeah. So you bring up a lot of different points. I think the Social Security is a big fear for a lot of people, but the good news is the politicians that I've spoken to have said it's an easiest fix. It's just nobody wants to be the person to promote it and be the one who sort of stands by that. But it'll be fixed because that's an easier fix. I think it's more of the Medicare, Medicaid kind of things that'll be
I
more
don't think,
challenging.
see, I used to think that, I agree that you would used to think that Social Security was the easy fix. It is. It's a math problem. It's not calculus. It's not higher math. It's a math. It's just like you either raise the Social Security wage base, you raise the taxes paid by individuals or employers, or you raise the age at which someone can claim. I'm not a huge fan of raising the claiming age. I just don't think that too many people are already counting on where they are right now. But anyway, so you do that. But we've been saying that now for 15 years and it's never happened. And so I think that there is a problem. I think that we should recognize that's a problem. And yes, I think Medicare is a problem. But if we can't even solve Social Security, which is the easy fix, I don't know. How are we going to make these other programs buoyant? How are we going to make them survive? So look, debt and deficit, they could be a problem. I don't think it's something we should actively worry about. The bond market is going to react one way or another to different things. And the people who are, bond market is bigger than the stock market. Okay. So it's a bigger amount of money that's in there, but I don't want people to like fret about that. It's out of our control. We kind of know how things work in cycles. And, one of my friends maintains this graph. His name is Michael Batnick. And he has this graph that's like, this was the worst time to invest. And he keeps updating it. And every time you think it's the worst time to invest, if you hold on, it's fine.
Yes. Which gets us back to the point is how does this actually impact my investing? And a lot of this short-term challenges, which of course we're worried about the long-term effects, are not the kind of things you want to react to when looking at your investment portfolio. But these are important topics to talk about. I think the way it was best described.
Hold on a second? Can I just they're sort of intellectually interesting, but do I think they're more important than, hey, Wealthstream person who walks into Michael's office, you're spending too much money supporting your kids, or hey, you have spent down way too much of your money too early in your retirement. Those I think are real problems.
That's right.
that we can actually control. So that's why I don't mean to dismiss it. I love this stuff. I'm nerdy. I love it. Okay. But do I really think that this is, I think intellectual curiosity is great, but I don't want what I don't want you to take away from this, that this is more important than anything you can control in your own financial life.
Yeah, I agree. And when it comes to these concerns around our financial system, whether it's interest rates, treasury bonds, or even the dollar, the best way that I've heard it summed up is that the United States is the cleanest dirty shirt in the laundry, if you will. Yeah. We are not an isolated case here. The entire world has these financial challenges, and our economy is stronger and more resilient than most of these other economies. So You have to also keep it in perspective. I think that's a really important viewpoint.
I have two new entrants into the webinar. Can we let them in?
Sure.
One is here. Yeah. Anyway, my dogs have entered, so sorry if they bark.
Yeah. Let's move into something a little less technical, but a little different, and talk about how you've seen or heard about AI impacting investment decisions, and what you see. And then, of course, I'll follow up with what we're seeing here at Wealthstream.
Yeah. Look, I think that anything that requires large data sets for analysis is ripe for AI, and that is investing. I'm just going to go back to David Booth for a second. He told me something wild, which is when he was at the University of Chicago, which is late 70s, basically, He said, "Do you know that Chicago and Harvard didn't have big, large mainframe computers in the late 60s? Like it took a while. Once they found that they could get this information, then they could sort of absorb that information and analyze that information. Well, so much of economics and investing is about looking at large data sets, chopping up the data the way you want to chop it up, and coming up with some uh, endpoint for you that is useful. So I think that is amazing. I would even suggest perhaps think about this. Maybe we just like throw all economic indicators that are in the US system and we throw it into an AI model, and that's our Federal Reserve. Maybe we shouldn't have human beings making those decisions. Honestly, maybe that they are too influenced by politics or they are too influenced by their recent past. So I think AI is great. I think in the investing world, that's really the biggest use. I mean, listen, all that stuff that you and I did as young financial planners, where we would, take our little HP 12C calculator and essentially figure out how to do a financial plan and doing it by hand. I don't know, how fast can you do those calculations? Once you have the data, how fast can you turn around a financial plan? It's going to be instantaneous. How fast will it be to incorporate different things like, hey, just peg this to inflation every year and like automatically update it? It's great. In my world, I'll give you an example. I was just having a conversation with a colleague today. There's a real discussion about, we cover a certain amount of events. We are all biased in the media. That is true.
Mhm.
We cover the things we want to cover. I'll raise my hand in our morning meeting and I want to get my thing on the air. So because I'm a good salesperson, I can get a lot on the air because I'm sitting with a bunch of news people. They don't know from selling. So I know
Mhm.
how to get them excited about my idea. Maybe that should be an AI driven decision. Maybe it should be every morning AI is going to comb through these 12 publications in the US, and maybe we make it geographically diverse, and maybe it's going to go through these social media things, maybe it's going to go through the international papers, it's going to come up with a list of a dozen stories that are very important to cover today, and then we go over it. Maybe that's generated for everyone in the news division by 4 o'clock every morning. We meet at 9 o'clock for 15 minutes to discuss if there's anything that we know is missed. That's a really different thing. We right now have a 9 o'clock meeting where there are 120 people on that meeting, and we are talking through the stories that we're covering. Now, that's fun and it's nice, and maybe there's creativity that's sparked, but maybe all that legwork can be done by AI by 4 o'clock in the morning. We can all read in, make a decision, update the model, and then push it through again. And so I just think that it's very exciting to me. And I think it's exciting to consider how AI will really help. It will be a tool for people. The good news for you and me, Michael, is that we happen to be in industries where AI can really help, but that you need a human touch.
Yeah, no doubt, no doubt. And so we see similar on our side, the ability to analyze a lot of data or even a research report and put it into AI and get the bullet points. So it's making us a lot more efficient and able to spend more time with our clients. But we want to make sure that we're giving the right advice for the client and understanding them. And AI is still not able to really, as you were saying earlier, understand that the clients may be spending too much money on their kids or something like that. So I think that that is a very important perspective to have. The other piece is a lot of people fear that AI will take a lot of jobs. And it might, but usually what happens is more jobs get created as a result of that. And I think back from my days in the accounting world as a CPA, I remember when TurboTax came out and the ability to do tax returns up by computer and not by hand. And they were all worried about how this was going to just basically kill all the CPAs and they wouldn't have jobs. And what's resulted in that is actually the opposite and more tax planning because you could get more information faster. You could do
Mm.
more proactive planning. And that's typically what happens is there's actually a burst in the economy when there's technology that creates more opportunities for more people. So a lot of fear there, understandably. It's a little spooky sometimes if you think about it. And also, I think we've seen a lot of bad things done with AI, a lot of cybersecurity concerns around
Hmm.
that. And that is something we need to be very vigilant around. But from a productivity standpoint, I think it's going to be a big plus.
Yeah, I mean, every big innovation, and I think this might be the mother of all innovations. I interviewed a woman who runs a publicly traded hedge fund in the UK. And when this is a real quant house, okay? And she talks about the most incredible things that AI can do. And she said, I'm going to hire differently. I'm going to hire differently. I think that's the issue. I mean, listen, it doesn't I guess that it also makes you think that if you think of every innovation comes with scary aspects to it, right? So Lotus 123 spreadsheet was supposed to be the
Yeah,
death of
yeah,
accounting.
yeah.
Then, as you said, then like the big tax houses like TurboTax, that's going to be the end of accounting.
Hmm.
Um, the idea of anyone being able to invest on their own is going to be the end of the advice of
Yeah.
of the
The
investment
robo, the
management and the
robo invest.
robo.
Yeah.
But even like an index fund, it was like that was supposed to be the death of the industry. And then it was the robos were going to be the death of the industry.
Yeah.
And so I think it's always change is scary. Okay. I'm a change junkie and even I am scared by AI
Yeah.
and I'm using it. I'm forcing myself to use it, but I know that it's really important. And I think that the nefarious parts are also pretty scary. I literally just said to my mother this morning, I'm like, Mommy, if someone calls and you don't know what that number is, don't pick it up.
That's
And if
right.
someone calls and it comes from a weird number and it sounds like one of your grandchildren, but it's not their number, just hang up
Yep. That's
and
right.
call
Good
us,
advice. Good
right?
advice. Yeah.
So I
Yeah.
think that it's exciting. It's and it's going to be interesting to see. By the way, I don't know. We have a lot of people who are listening might have kids or grandkids. I don't know if you saw this, and I don't know if this is really AI related yet, but the unemployment rate for young college grads is off the wall right now.
Yeah. It's not
It's
good.
off the wall, and I'm not sure that that's AI, but I
Oh
do.
no.
I that's not the AI thing yet, but something is going on in corporate America around recent grads, and maybe it's that they're not cutting jobs yet, but and so people are in their jobs longer, and there are no job openings. But something strange is happening, and the numbers are very distinct. College grads who are 22, or let's call it 21 to 27 years old. Something weird is going on. I'm trying to get to the bottom of it. Anyone else have an idea about it? Let me know.
Yeah. Well, I would think that a big factor might be the boom we've gone through, and a lot of companies have been borrowing at lower interest rates, been investing, hiring, growing, doing a great job, and now we're in this period of uncertainty. We're not sure about what's going to happen to tariffs and how those affect certain businesses. We're not sure about what's going to happen to interest rates
Yeah.
further and the cost of maintaining that debt that they took out at lower rates. And there's a lot of trepidation about what's the next step for me as a business owner, and do I want to make that investment in a new hire, or do I want to try to just create more from what I have now? So I think
Right.
that's a factor.
Right. Or do I want to just buy AI
Yeah,
products?
yeah, exactly, exactly. Well, Jill, we're having a great time here, and we're almost up on the hour.
How
I'm
is
going
that
to just,
possible?
yeah, I just want to get in. We have two questions. The first one I want to get in is we were talking about Social Security
Hmm.
and if benefits are going to get cut. We've historically counseled clients, generically speaking, to sort of enjoy that wait to 70 because of the 8% return that they're getting. But of course, that's generic. And we look at the situation. We want to understand the relationship between the spouses and how they're collecting and the ages that they are and what the benefits are, and also what their other income assets are, when they're retiring, et cetera. But do you have any more, akin to your Jill on Money podcast where you talk to a lot of people about this? Do you have any sort of thoughts around, whether people should wait to their full retirement age or take it sooner?
So I always say wait if you can.
Yeah.
Waiting's better. It's like there's no doubt about it in my mind. I love that there's a woman who is following this very specifically. Her name is Teresa Ghilarducci. She is a professor at the New School in New York City, and she is a retirement expert. I think her last, oh God, I can't remember what the book was called. It was something like Work, Retire, Repeat, or something like that. But she
Mhm.
really studies retirement, the retirement system. She's fantastic. So I just interviewed her for an evening news. I did a long, like a series with her about retirement advice for people in their 40s, their 50s, and their 60s. And then I went back and I went and just recently interviewed her. And I said, Teresa, let's talk about these cuts that are automatically going to happen to Social Security. Does that argue for claiming Social Security benefits early? She goes, absolutely not. In fact, it argues for waiting because the 20% reduction will be on the larger amount if it were to come. So, and the reason that you would, the only reason that you claim early is that if you have to, you need the money.
Yeah.
Or you have a really bad life expectancy.
That's right.
I had someone come on the program and they have stage 4 cancer. And I'm like, claim.
Yeah.
Just
that
claim.
makes perfect sense.
By the way, on my father's deathbed, he died when he was 76. One of the things he said to me was, you see, isn't it smart that I claim Social Security early? I said, yeah, what about mom? She's getting half of yours. So that's
exactly.
Good
Maybe
for
you should have
you.
waited a little longer.
Yeah, exactly.
All right. And we have the last and final question here before we wrap up is, what show are you going to see this evening?
I'm going to see Smash before it closes. So that's number 1. And number 2 has been an incredible season for Broadway. I encourage everybody to go. Number 3, I love Michael Goodman, as you all know. But if you want to ask a question, you don't want to bother Michael or his team, you can always ask me a question. You can, I won't tell him.
Dealonmoney.com? Is that
Dealonmoney.com, and we have a newsletter, and we've got all sorts of fun things. So you should check that out. And I want to say that as somebody who has been of this business, I just was at a conference in LA with a bunch of advisors who were also like Wealthstream. They're associated with Dimensional. And the thing that I think is fascinating about this group of people, including the folks at Wealthstream, but what I think is fascinating is people who are dedicating their lives to kind of improving people's outcomes and helping to basically move the clutter to the side. And that clutter can be emotional. It could be the math part of it. And so one of the reasons I think it's important to have that as someone in your life is that it can help you do the things that you want to do, like go to Broadway shows. But if you have any kind of questions or any concerns, go to Michael. And if he can't answer it, then he'll send you to me.
Yeah, of course. Always feel free to reach out to your Wealthstream contact. We're happy to help in any way. But also, JillOnMoney.com. Also a fantastic podcast. It's a great, not only informative, educational, and interesting podcast, but Jill does, obviously, as you can tell, adds in a wonderful sense of humor to it, and it's a pleasure to listen to.
And if you have kids who are watching, like if they're watching those Finfluencers, we have a second podcast that's called Money Watch. It drops on Saturdays and Sundays, and it is more of the building blocks of your financial life. So both of those are on the website.
Yeah. Jill, thank you so much for being with us today. It's always a pleasure. I'm grateful for the opportunity to spend this time with you. And thank you, everybody, for listening today. And we look forward to our next webinar. Thank you so much.
Thanks.
Bye-bye now.